After the June 22nd vote from Iran's parliament to restrict the Strait of Hormuz, most global analysts expected a military flashpoint. But the follow-through didn't come from the Navy, it came from tankers. Instead of escalating with rockets, Iran opened the taps. Within 72 hours of the vote, vessel tracking firms flagged a visible uptick in Iranian oil leaving Gulf ports. More tankers, heavier loads, and a clear pattern. Everything was heading east. This wasn't a bluff or posturing. It was targeted at economic retaliation. Throne wasn't aiming for headlines. It was aiming at the U.S. economy, not through war, but through supply chains, prices, and pressure. While Washington braced for confrontation, Iran quietly executed the first move, exporting its way out of sanctions and into leverage. By mid-June, China was receiving well over 1.1 million barrels per day of Iranian crude, a level not seen since early 2023. Much of it moved via dark fleet tanker vessels, stripped of transponders operating through ghost registries. As of late June, nearly 90% of Iran's total crude exports are going directly to Chinese buyers, a dramatic concentration that shows deliberate coordination. Major Chinese teapot refiners, especially in Shandong, are receiving discounted cargoes, storing them in bonded zones, and refining them at scale. Official customs filings cross-referenced with marine tracking confirm the trend. And unlike prior years, these flows are not sporadic. They're consistent. Daily arrivals, reliable ports, and refiners are already optimizing output from Iran's heavier grades. What's changed isn't just the volume, it's the strategy. Iran is using oil not to escape sanctions, but to gain advantage. And China is quietly endorsing it by accepting, processing, and integrating Iranian barrels into its core energy mix. The more oil Iran redirects to China, the less flexibility global markets have. And that's exactly what started to show in the numbers. By late June, Brent crude was climbing again, hovering near $78 a barrel. The Fed, which had already held rates steady earlier in the month, began signaling concern. Internal reports flagged energy prices as a renewed threat to inflation control. Donald Trump built his return campaign on the promise of energy dominance. Lower gas prices, stronger supply chains, and no foreign threats. But the numbers tell a different story. The U.S. Strategic Petroleum Reserve remains below half of its 2020 peak, sitting around 402 million barrels. That's not enough to cushion real external shocks, and the administration knows it. Iran's redirected exports pushed Brent higher, and U.S. refineries, many of them tied to Brent, not WTI, have already started absorbing the hit. That means higher processing costs, thinner margins, and price pass-through to consumers. This wasn't supposed to happen under Trump, but it is. And he doesn't have the levers to stop it because this isn't about war or production. It's about access, and Iran just shifted the flow. What's striking isn't what the White House said after Iran's vote. It's what they didn't do. Internally, U.S. agencies flagged Iran's oil redirection as a strategic escalation, not just a trade shift. Treasury analysts mapped crude flows in real time. The Energy Department recalibrated import exposure. Defense officials outlined retaliation scenarios that were scrapped within hours. The problem wasn't awareness, it was constraint. Any military move risked a spike in Brent well above $100. Any new sanctions would be ignored by China. And any open retaliation could turn economic pressure into an oil panic. Every lever had a cost. In the days after Iran's June 22nd vote, oil exports surged past 1.3 million barrels per day. Nearly all that volume was rerouted to China. Satellite data and bonded customs records confirmed arrivals at Qingdao, Zhoushan, and Dalian. Chinese refiners were receiving the cargoes under long-term arrangements that bypass U.S. sanctions enforcement entirely. This shift left Western buyers boxed out. Spot markets in Europe and Asia tightened as Iranian supply disappeared from open bidding. Alternative grades from Iraq, Kuwait, and Saudi Arabia began trading at a premium. Market data showed that Western refiners were forced to secure smaller, less favorable cargoes with higher delivery risk and added freight costs. What's changed is the power dynamic. Iran has effectively locked its barrels into a state-backed pipeline to China. These aren't temporary deals, they're structured flows. Washington can't interrupt them without escalating into something far more serious. The result is that Iran secures stable revenue, China deepens control over Middle East flows, and Western access continues to narrow. Real-time AIS data showed a 28% decrease in fully loaded transits compared to early June averages. Several supertankers delayed their crossings, while others adjusted routes around Oman to reduce risk exposure. These decisions weren't based on speculation. They were made in response to confirmed government votes and new risk classifications from regional authorities. Freight rates reflected the shift immediately. Day rates for very large crude carriers jumped from around $43,000 to over $60,000. Insurance providers increased war risk premiums on Gulf routes. Port bulletins in the UAE and Oman cited congestion and slower traffic, forcing carriers to build in added delays to delivery schedules. This directly raised the per-barrel cost of delivery even without any military confrontation. This is economic pressure without physical interference. There were no blockades, no missile threats, just real-world hesitation. And that hesitation added measurable cost to every barrel leaving the Gulf. For buyers in Europe and Asia, that's already showing up in landed prices. For producers, it's a reminder that a single policy vote enthroned can still shape global freight behavior. As Brent crude climbed from $74 to nearly $78 by June 23rd, central banks across the West took notice. The Federal Reserve's internal June guidance flagged oil flow uncertainty in its inflation modeling. Briefings leaked to major U.S. financial outlets confirm this. The European Central Bank also revised its energy risk scenario in its mid-June inflation outlook. These weren't symbolic updates. They affected forward guidance and delayed interest rate decisions that had been expected weeks earlier. Bond markets responded instantly. The probability of U.S. rate cuts before Q4 dropped. Traders shifted inflation expectations upward as shipping premiums and supply concerns filtered into real pricing. The message was clear. This wasn't noise. Iran's export redirection caused a meaningful shock to the central inputs that shape monetary policy in Washington and Frankfurt. These reactions showed that Iran didn't just move barrels, it moved policy. Without launching a single threat, the flow shift triggered enough disruption to push central banks back onto defense. That's the scale of impact Tehran achieved by tightening its oil relationships with Beijing and forcing others to absorb the cost. The U.S. has few tools left to influence how Iran sells oil. Sanctions haven't stopped shipments, and attempts to block insurance or maritime services have been bypassed. With China now absorbing nearly 90% of Iranian crude, Washington's traditional pressure points, banking, transport, and international compliance, no longer apply. The White House has not issued a direct response to the June 22nd vote or the spike in exports to China. National Security Council spokespeople declined comment when asked if Iran's redirection violates any new U.S. guidelines. Without multilateral enforcement or EU alignment, the U.S. is essentially watching Iran rewire its oil trade without recourse. This is what economic isolation looks like when it stops working. Iran isn't escaping pressure, it's rendering it irrelevant. And at this point, Washington is stuck between reimposing costs on allies or accepting that Tehran's oil flows are now out of reach. From June 18th to June 23rd, Chinese bonded ports received the highest volume of Iranian crude since 2022, based on satellite verification and customs entries. These barrels are being processed, stored, and traded at a commercial scale, with full backing from Beijing's regulatory system. By acting as the anchor buyer, China is not just absorbing discounted oil. It's positioning itself as the stabilizer for producers under U.S. pressure. Tehran benefits from guaranteed revenue. China benefits from price leverage and supply control. And every barrel moved through this channel reduces U.S. visibility over global flows. This isn't just about one trade lane, it's a strategic shift. China is turning its oil partnerships into long-term leverage, and no Western institution is blocking it. Iran's response to pressure didn't come in the form of a military escalation. It came through oil, The June 22nd vote was framed as a threat to the Strait of Hormuz, but Throne didn't close it. Instead, it rerouted exports, locked in China as its key buyer, and shifted global market behavior without confrontation. Tanker data changed, refinery inputs changed, and central bank projections changed. Thran moved the market by making its oil available only on its terms, and it worked. Brent prices rose, Western supply tightened, and shipping costs increased, all within a matter of days. Washington expected provocation. What it got was a long-term adjustment that left it watching from the outside. That's what makes this a successful retaliation. Iran didn't need to close the strait. It didn't need to launch anything. It just moved barrels, and in doing so, it cornered the US on energy, inflation, and leverage. Oh, here's the question. If economic retaliation works this well, does the US have any way left to respond without WW orsoning it? Know in the comments and stay subscribed.